Last week, the Federal Reserve cut interest rates for a second time this year, but don't expect your wallet to feel any relief just yet, right? Credit cards interest may tick down pennies, fixed loans won't budge, and saving yields could start to slip. But where's the opportunities for families to stretch that dollar as far as they can? Consumer Reporter joining us now is Lisa Gill. Lisa, welcome back to the show.
Good morning. Thanks so much for having me.
All right. When you hear interest cuts, right, interest rates cuts, people often expect immediate relief, especially on their credit cards. But why doesn't it work that way?
Well, the cuts are actually really tiny. I mean, a quarter of a point, you're not really going to see as it goes through the system. It's only going to translate, as you said, to sometimes pennies on the dollar. But I will say this, this is the second cut. And although I'm not an economist, I'm a consumer reporter, it does signal to us that probably more cuts are coming in the future. But there are two other places besides credit cards that you might see a change in your payment. And that is adjustable rate mortgages. And so those are the kind that are tied directly to prime. And so those, you might see a change, might be $50, $30, but hey, that's something. And also I would say between credit cards, adjustable rate mortgages, also HELOC loans, so home equity lines of credit, or even maybe the home equity loan, if they're tied to prime, definitely with the credit, you'll see a change in what you pay every month. And it could be, if there's more cuts coming, you'll see it go down even further.
Lisa, what is the biggest mistake you think people make when we hear about rates cutting or rates starting to fall?
Yeah, they rush to refinance their homes or rush to get that home equity line of credit or home equity loan, because there's sort of that feeling of like euphoria of like, oh, this is now, credit will be cheaper. But I would say at this point, with only 2 rate cuts, although again, I'm not an economist, I would personally say just hold off for that kind of loan or that kind of refinancing until we see some additional cuts. I mean, again, a quarter of a point each time is not, it's small. It's not big enough.
Well, we see many Georgians relying on online banks or credit unions. Where can they still find the best return on their savings?
Believe it or not, your local credit unions typically have some of the highest interest rates, both for savings and certificates and money market accounts. Those are, we kind of forget about your credit unions, but credit unions, it doesn't have to be necessarily affiliated with the profession. It can be just in your neighborhood, but don't hesitate to go knocking on the door to find out what kind of return you can get for your savings accounts and other sort of similar accounts. Yeah,
you mentioned more cuts coming down the road. Well, that could actually change. Hopefully, yes. Yeah. You can your fingers crossed. Yeah. How would that change for borrowers and what they would pay, or is it just too small to move the needle?
Well, it compounds over time. So basically, you would see that third, maybe fourth cut, and you start to see like a real change in what that prime rate is. So you would see a lower rate for the interest mortgage, both for the ARMs and even a fixed 30-year. You mentioned earlier, those fixed 30-year mortgages, you're not going to see any change in your payments today at all. And same with car loans and a lot of student loans. But it's the adjustable, anything that's tied to prime. But once those cuts start to happen, you'll see some of those figures ticking downward. And if you're in the market to buy a home, this is not a bad time.
Yeah. All right, Lisa, thanks so much for your insight. Really appreciate it.
Yeah, thanks. Thank you.
All right.